There you go. So let's bring in here Sean Langcake, Head of Macroeconomic Forecasting at Oxford Economics, who's with me. Sean, more economists are now pushing their forecasts of when interest rates are going to be cut further out. What's your own sense of that, given what we've heard from the Governor today?
Yeah, I think as she alluded to, they're going to need a great deal of confidence that inflation's on its way back to target. I don't think even two positive CPI reads are going to give that to them. And there's also plenty of scope still for a bit of an upside surprise on inflation on the way through. So we're not expecting a cut until November, but really the chances are that it's even later than that, more so than being brought forward.
Yeah, so the change in language, and I mean, we can see where the cash rate's gone historically, and now it's become pretty flat. Here's some of the assumptions. Wages growth appears to have peaked, with indications it will moderate in the year ahead. Real incomes have stabilised and are expected to grow from here. Expect to support growth in consumption later this year as well. That's one interesting thing. That is kind of like the steady as she goes, if you like, forecast of the Reserve Bank, isn't it?
It is. Look, we've really only just got real incomes growing again, having gone backwards for the last couple of years with inflation running so hot and taking such a bite out of people's paychecks. So we are moving to a position where we're going to have a little bit more support for consumption, tax cuts from the second half of the year. That's going to help as well. But yeah, that is all to the upside for inflation. It means they're going to take a very patient approach in easing policy.
So it's a very patient approach, but taking off that language which says we might even raise rates. And this is it. This has been deleted from the previous month's statement, and a further increase in interest rates cannot be ruled out. We can see also what they've replaced that with. The board is not ruling anything in or out. So the language has subtly but very clearly changed.
It has. I think it's worth bearing in mind that market expectations were pretty dovish around the time of that previous statement. So I think what the bank has seen is those expectations have lifted a little bit. They're more comfortable with where the market sees policy rates going, and they've kind of softened that language ever so slightly.